Imagine diligently packing money into a 401k for 40 straight years, watching the balance slowly climb, only to reach the eve of your retirement and realize you are absolutely terrified to spend a dime of it. For millions of Americans, this is the reality of the 4% rule. The math of this standard retirement strategy relies on a slow, deliberate liquidation. To pay for your life, you have to chip away at the principal, systematically selling off the very shares you spent decades working to accumulate. Because your financial survival depends on liquidating assets, you are forced into the role of a speculative gambler. Every sudden dip in the broader market directly threatens your ability to pay your bills, holding your lifestyle hostage to unpredictable daily price swings. But the ultra-wealthy approach their capital differently. They do not slowly bleed their portfolios dry. Instead, they engineer their holdings into a shadow business, a structure designed specifically to generate relentless, predictable cash flow without ever requiring them to sell a single underlying asset to keep the lights on. Transitioning from a market speculator to a true equity owner means looking past standard growth stocks. It requires building a yield fortress, a portfolio utilizing 3 specific, highly regulated legal strategies to collect a consistent paycheck simply for holding the asset. The average S&P 500 index fund pays out a dividend yield of around 1 or 2%, a rate that barely keeps pace with inflation. To build real income, you have to pivot to specialized asset classes that are legally mandated to distribute the vast majority of their corporate profits directly to shareholders. Curious, analytical tone. The first building block is the Covered Call Exchange-Traded Fund. Until recently, the underlying mechanisms of these vehicles were highly complex tools utilized almost exclusively by institutional elites to extract cash from volatile markets. Here is how they work. The fund holds a core basket of traditional stocks, but it simultaneously writes options contracts, essentially selling the right to buy those stocks at a certain price in the future, against that exact same basket. The act of selling those contracts generates heavy monthly premiums. Instead of being locked up in corporate treasuries, that cash is passed straight through the fund and deposited directly into your personal brokerage account. By wrapping this strategy inside an ETF, the risky job of manual options trading is entirely automated. You simply buy the shares, and the fund does the heavy lifting to deliver a high-yield cash drop month after month. The second pillar shifts your role entirely. Instead of holding traditional stock, business development companies, or BDCs, allow you to operate as a private creditor. Traditional banks often ignore mid-sized companies that need capital to expand their physical operations or build out infrastructure. BDCs step in to fill that gap, pooling money from retail investors and lending it directly to these growing American businesses. Because these loans provide crucial middle-market financing, the BDC is able to charge a significant premium. As the lender, you are legally positioned to capture those double-digit interest rates as a return on your provided capital. When you integrate the aggressive interest of BDCs with the steady premiums of covered calls and the historical reliability of companies that have raised their dividends for decades, you construct a highly diversified machine that throws off serious cash every 30 days. But generating all of this cash exposes a massive structural threat. If you hold these high-yield assets in a standard brokerage account, the federal government will classify those payouts as ordinary income. Paying your top marginal tax rate on every monthly distribution slices a massive percentage right off the top. This heavy, recurring tax drag cripples your mathematical ability to compound your wealth over time. This is why the third pillar, strategic asset location, is absolutely critical. Wealthy investors do not just pick the right assets, they place them inside specific legal vaults created by IRS incentives to isolate their highest-yielding income generators. By shielding these specialized funds inside a tax-advantaged vehicle like a Roth IRA, you legally bypass the standard income tax bracket. The federal tax burden on those massive monthly dividend payouts drops to absolute zero. Capturing high returns is only half the equation.
True, lasting wealth generation relies on systematically using the legal tax code to ensure every single penny of that yield stays entirely inside your control. If you are still in your accumulation years and do not need to pull that income to pay your daily living expenses just yet, you can put this machine into overdrive. By instructing your brokerage to automatically reinvest every one of those tax-free distributions back into the underlying assets, you will trigger a runaway snowball effect. This creates a compounding cycle that scales your ownership without further out-of-pocket investment. Your initial cash buys a block of shares. Those shares generate a dividend, which instantly buys more shares, which in turn generate a larger dividend to buy an even bigger block of shares the following month. As the loop continues, your portfolio reaches a measurable threshold. The moment your monthly tax-free dividend income surpasses your monthly living expenses, you have achieved financial independence. You no longer have to stress over your FICO score, or attempt to perfectly time market tops, or panic during the daily ticker fluctuations. You know your bills are covered, regardless of what the broader economy decides to do. You are no longer working for money. You have engineered a self-sustaining system where your money works for you, building a protected legacy of generational wealth that can sustain your family for decades to come.